When we think about money, we imagine something simple. You work, you get paid, you spend. It seems like a natural system, but the reality is much more complex. Behind every coin, every bill, and every number in your banking app, there's a gigantic system of rules, institutions, and control mechanisms. Governments don't just create money, they influence. How much money exists, how it circulates, how much it's worth, who can use it, and until when it can be used, these mechanisms shape entire economies. They can stimulate growth or provoke crises. Today we'll explain the main ways governments control money. And when you understand how this system works, you'll realize that money is much more political than it seems. The first form of control is the most fundamental. Who creates money? In most countries, this power belongs to the government and the central bank. Historically, money began as something physical. Gold, silver, metallic coins, but over time, governments took control of its issuance. Today, almost all money is fiat currency. This means it has value because the government says it does, not because it's linked to gold or another physical resource. When the central bank decides to issue more currency, the amount of money in the economy increases. When it restricts issuance, the supply decreases. This power of creation directly influences inflation, credit, and economic growth. Another powerful tool is interest rates. Central banks set the base rate that influences the entire financial system. When interest rates are low, loans become cheaper, companies invest more, consumers spend more. When interest rates are high, credit becomes expensive, consumption decreases, inflation tends to fall. Adjusting interest rates is like controlling the speed of an economic engine. Small changes can affect millions of people. When economies enter a crisis, governments may resort to a controversial tool, creating more money. This can happen through policies such as quantitative easing. In this process, the central bank buys financial assets to inject money into the system. The goal is to increase liquidity and stimulate economic activity, but if done excessively, it can generate inflation. And inflation means that the value of money decreases. Governments also control the financial system through banking regulation. Banks must follow rules regarding minimum reserves, loans, capital. These rules exist to prevent financial collapses. But they also influence how much money circulates in the economy. Because banks don't just hold money, they create credit. And credit functions almost like new money. Perhaps the most visible mechanism of control is taxation. Governments collect taxes to fund public services. But taxes also influence economic behavior. For example, high taxes on tobacco reduce consumption. Tax incentives stimulate investment. Income taxes redistribute wealth. Taxation shapes how money moves within a society. Inflation is often seen as a natural economic phenomenon, but governments directly influence this process. When the money supply grows faster than the production of goods and services, prices rise. Some level of inflation is considered healthy, but high inflation can erode economies. Controlling it is one of the main responsibilities of central banks. Countries also control how their currencies interact with the rest of the world. Some governments let their currencies float freely. Others maintain fixed or managed exchange rates. This affects international trade, exports, and imports. The value of a currency can influence global competitiveness. Governments also control money through the issuance of debt. When a country needs resources, it can issue bonds. Investors buy these bonds, lending money to the government. This mechanism allows for financing expenses today and repayment in the future. However, excessive debt can generate economic pressures. Financial markets don't operate without rules. Governments impose regulations to prevent fraud, avoid market manipulation, protect investors. These rules influence how capital circulates and how companies access financing. With the advancement of technology, new instruments are emerging. Many governments are exploring central bank digital currencies, CBDCs. These currencies exist only in digital format. They can enable instant payments, greater traceability, new monetary policy tools, but they also raise debates about privacy and control. Money is not just an economic tool. It is also a tool of power. Whoever controls the monetary system influences investments, prices, growth opportunities. This doesn't mean that governments control every individual decision, but they shape the environment where all these decisions take place. And understanding this system is essential to understanding how modern economies really work.